Hello, property investors. If you're aiming to expand your real estate portfolio in Bengaluru, choosing the right financing option for rental property acquisition is critical. The right funding strategy can mean the difference between long-term profitability and a costly setback. With a range of traditional loans, innovative lending products, and alternative funding avenues available, understanding each option's pros and cons is vital. In this video, we'll guide you through the most effective financing strategies for rental properties. Whether you're a new investor or managing multiple rentals, you'll gain clarity on how to fund your property goals and maximize returns with smarter financial planning. 1. Traditional bank loans, the foundation of property financing. Traditional bank loans remain the most common and trusted route for financing rental property purchases. These loans come with structured repayment terms, competitive interest rates, and long tenures, making them ideal for investors seeking stability. Qualifying typically involves presenting a strong credit score, verifiable income, and a substantial down payment. Banks may also assess the projected rental income of property to evaluate your repayment capacity. This form of financing is especially beneficial when purchasing well-established rental units with consistent income potential. 2. Government-backed loans, easier entry for new investors. Government-backed home loan options such as FHA or VA loans, where available, can be a boon for first-time investors entering the rental market. These loans generally require a lower down payment and are more lenient in terms of credit requirements. However, eligibility criteria often include stipulations about property type and residency, such as occupying one of the units in a multifamily property. For those with limited savings or weaker credit history, these options offer a practical stepping stone into rental property investment. 3. Portfolio loans, tailored lending for multi-property owners. For seasoned investors managing multiple rental assets, portfolio loans present a powerful solution. These loans are structured to finance several properties under a single lending agreement. Offered by select financial institutions and private lenders, portfolio loans take into account the overall performance of your property portfolio, not just individual assets. This allows for more flexibility in underwriting and streamlines financing across multiple acquisitions. It's an excellent choice for scaling your investment footprint efficiently. 4. Hard money loans, speed over structure. When time is of the essence, especially in competitive real estate markets, hard money loans can be a game changer. Issued by private lenders and secured against the property's value, these short-term loans prioritize asset evaluation over credit history. They're suitable for investors who may not have all their documentation ready or need to act quickly. Keep in mind, however, that this speed comes at a cost. Higher interest rates and shorter repayment periods make these loans best for quick turnaround investments or bridging finance. 5. Home equity loans and HELOCs, unlocking existing value. If you own property with built-up equity, leveraging that value through a home equity loan or a home equity line of credit HELOC is a smart move. A home equity loan provides a fixed lump sum, while a HELOC works like a credit card with a variable rate. Both options allow you to use equity from your current residence or other investment properties to finance new purchases. This method is cost-effective and can reduce borrowing expenses, especially when compared to unsecured personal loans. 6. Seller financing, custom deals without the bank. Seller financing is a flexible alternative where the seller acts as a lender. Instead of traditional mortgage, the buyer agrees to pay the seller in installments, often with negotiable terms. This strategy is useful for buyers who may face difficulties with conventional loan approvals or are seeking more personalized payment structures. It also benefits sellers by generating interest income. While the terms can be tailored, it's essential to have legally binding agreements to protect both parties. 7. Real estate crowdfunding, investing together, earning together. Crowdfunding platforms have transformed how investors participate in real estate. These platforms allow individuals to invest smaller amounts into pooled property deals, earning passive income and sharing in appreciation. The platform typically handles property acquisition, operations, and financial reporting. This is an attractive option for those who prefer hands-off investment or wish to diversify their holdings without directly owning or managing property. It lowers the entry barrier while still offering exposure to rental property income. 8. Private money lending flexibility through relationships. Private money lenders, whether individuals or investment networks, offer short, to medium-term loans based on personal relationships and mutual investment interests. These loans are less regulated than traditional mortgages, allowing for tailored agreements, faster approvals, and fewer hurdles. They're an excellent choice for investors who need quick funding and have access to trusted personal or professional networks. While they may come with higher interest rates, the convenience and adaptability they offer can outweigh the cost in time-sensitive scenarios. 9. Using retirement accounts, building long-term wealth strategically. In some regions, investors can use retirement accounts like self-directed IRAs to purchase rental properties. These accounts offer powerful tax advantages, either tax-deferred or tax-free income growth. However, strict compliance is required. For instance, you can't live in or personally benefit from the property, and all income and expenses must pass through the retirement account. Used properly, this method can help build a diversified and tax-efficient retirement portfolio while generating rental income. 10. Joint ventures and partnerships scaling with shared resources. Joining forces with other investors through a partnership or joint venture can be a strategic way to finance large or ambitious rental property purchases. One partner might bring the capital, while another contributes property management experience or market knowledge. Pooling strengths allows for shared risk and greater opportunity, but it's essential to establish clear legal agreements that define roles, responsibilities, profit sharing, and exit strategies. Strong collaboration and shared vision are key to long-term success in property partnerships. Bonus tip: how SANGAU supports smarter rental financing. At SANGAU, we recognize that financing is one of the most critical steps in successful property investment. That's why we don't stop at property management. We also offer insights and support throughout your rental financing journey. From helping you prepare documentation to referring you to trusted mortgage advisors and legal experts, our team is with you every step of the way. Whether you're applying for your first loan or negotiating a private lending deal, SANGAU ensures that your financing aligns with your long-term investment goals and maximizes rental yield in Bengaluru's dynamic property market. Thanks for watching. If this video helped you better understand financing options for your rental property investment, don't forget to like, share, and subscribe to our channel. Stay tuned for more expert guidance on property management, investment strategies, and navigating Bengaluru's real estate market with confidence. See you in the next video.